Okay, let's unpack this. You know that feeling when you walk into a Target? There's something different about it, right?
Definitely.
It's often called Tarze, that unique blend of style, affordability, and experience.
Mhm.
It's a major player in U.S. retail. And figuring out what makes them tick, especially after, well, a challenging year, is what we're diving into today.
Absolutely. It's a company that really aims to be more than just a place to buy things. It's about the whole experience and the curation.
Exactly. And we've got their 2024 annual report right here. Think of this deep dive as your uh, essential shortcut.
Straight from the source.
Yep, straight from the source. We're pulling out the most important insights to understand what Target has been doing, how they performed last year, and where they're telling us they're headed.
Right. No need for you to wade through hundreds of pages.
We're getting to the core of it for you.
Our mission here is really just to extract those key pieces of information about their strategy, their performance, directly from their own reporting. It helps you see the story the company is telling about itself and its future.
So let's start with how Target defines itself, its place in the market.
Hmm.
The report talks about operating as a single, unified segment.
Combining stores and digital.
Yeah, combining the physical stores and their digital channels.
And that single segment approach, it's pretty fundamental to their strategy. It reflects how they think about the customer experience. It should be seamless, right?
Right.
Whether you're on their app doing a drive-up order or walking the aisles in person, they see it all as one interconnected business.
And they actively lean into that Tarze concept we mentioned.
They do.
The report actually defines it as their unique blend of affordability, style, and newness, specifically at the intersection of products and experience. It's about creating that distinct vibe.
That distinct identity is absolutely their key differentiator in a very crowded retail space. And the report details the core elements of the strategy they believe will expand their relevance and drive growth.
Okay, let's dig into that strategy then. What are the main pillars?
First, it's about delighting guests. Newness, style, and value. A massive part of this is their own brands.
Oh yeah, like Cat and Jack, Threshold.
Yeah, exactly. Good and Gather. Those owned brands, believe it or not, account for about 1/3 of their total merchandise sales.
1/3. That's huge.
It is.
That gives them significant control over product, quality, margin. It's not just stocking other people's stuff.
Precisely. It allows for much greater differentiation. Alongside that, of course, they feature key national brands and those signature partnerships you see.
Like the Apple shops, the Disney corners, Levi's sections, and those Ulta beauty shops right inside the store. Those definitely add to that curated, slightly, elevated feel.
Exactly. They bring excitement, they bring traffic, and they reinforce that whole Tarze feel. So the second pillar is delivering the value,
Okay.
which they do through, everyday low pricing, promotions, and of course the Target Circle loyalty program.
Value is crucial, yeah, especially now. And the third pillar.
Enhancing the experience itself. This involves pretty significant investment, both in their physical stores and on the digital side.
Right. They're not slowing down on the physical stores, are they?
Not at all. They opened 23 new stores in 2024, and they're planning around 20 more for 2025. Plus, extensive remodels of existing locations.
So the physical store is still incredibly important, even as digital keeps growing.
Very much so.
And speaking of digital, it's a massive business for them now. The report says over $20 billion annually.
It is, yeah. And it saw strong double-digit percentage growth last year, particularly in their same-day services like Drive Up and same-day delivery.
The ones everyone uses.
Right, which are heavily utilized by Target Circle members, especially with the new Target Circle 360 subscription.
Okay, here's where it gets really interesting, I think, how they use those physical stores. They're like strategic hubs for digital fulfillment.
Absolutely.
The report states that over 65% of their digital sales are fulfilled directly from their stores.
That is such a critical integration point. It lets them leverage their existing store footprint, their inventory, to get online orders to customers faster, more efficiently.
Makes sense.
And that store-fulfilled digital channel, it grew 7.7% in 2024 compared to the prior year. So it's clearly becoming even more important in their overall model.
Okay, so that's the strategy, the infrastructure. How did that translate into actual performance and trends in 2024? Looking at the top line, net sales came in at $106.6 billion.
That's a slight decrease, about 0.8% compared to $107.4 billion in 2023.
Okay, that headline number looks like a dip. But the report immediately gives us some crucial context, right?
Yeah, exactly. 2023 was actually a 53-week fiscal year for them.
Ah, right. Not the usual 52.
And that extra week alone contributed $1.7 billion to their 2023 sales.
So if you account for that extra week, the picture looks quite different. It really highlights why you got to dig into the details beyond just the top-line percentage change.
Absolutely. And looking at the longer view, the report points out their net sales have a 5-year compound annual growth rate. That's their average annual growth of 6.4% since 2019.
So despite the recent volatility, that shows pretty substantial growth over the past half-decade.
And they attribute that 5-year growth largely to traffic. Get this, they had 350 million more guest trips in 2024 compared to 2019.
Wow, 350 million more. So people are coming to Target more often than before the pandemic.
Seems so.
That traffic growth is really significant, especially when you consider the challenging retail environment the CEO mentioned in his letter.
Yeah, he noted a high level of variability throughout 2024. Consumer demand, particularly for, the discretionary categories, the wants, not the needs.
Right.
It's been shifting around a lot because of pandemic impacts and inflation pressures.
Makes sense. People are watching their wallets.
But despite those shifts, they did see some positive signs, like gains in their discretionary business during the recent holiday season.
Okay, good.
And that, combined with continued strong performance in essential or frequency categories, think food, beverages, household essentials.
The stuff you always need.
Exactly. They feel that combination positions them well for continued top-line growth going forward.
Okay, let's look closer at comparable sales. That metric gives us a better apples-to-apples view, right? Only looks at stores and digital channels open for a full year.
Correct. And in 2024, comparable sales showed a slight increase, 0.1%.
0.1%. That's a notable improvement from the year before, 2023, which was a decrease of 3.7%.
It is. It indicates a stabilization in sales trends over the past year, which is encouraging for them.
And we can see the drivers of that small increase. The number of transactions of traffic we talked about was up 1.4%.
But the average transaction amount was down 1.3%.
So more people came to Target.
Yep.
But on average, they spend a little less each time they visited.
Which aligns with that broader consumer trend we're seeing everywhere, focusing on value, maybe pulling back slightly on the bigger discretionary purchases.
And the performance varied quite a bit depending on how people shopped. Comparable sales from their physical stores actually decreased by 1.6%.
Right. While comparable sales from digitally originated orders grew by a strong 7.5% in 2024.
Okay, so that really underscores the continued strength of their digital channels and that shift in how customers are choosing to, well, complete their purchases, even if maybe they started browsing online or in the app.
Precisely. The integration is key.
Okay, let's shift gears a bit and look at the financial health behind these trends. What do the key figures from their income statement tell us?
Okay, so operating income was $5.6 billion in 2024. This is basically their profit before things like interest and taxes.
Got it. $5.6 billion. That's down slightly, a 2.5% decrease from $5.7 billion in 2023.
It is, though it's worth noting they had that significant jump to $3.8 billion back in 2022. So while it's down slightly from 23, it's still well above that 22 level.
Okay, that's important context. And net earnings, the bottom line profit.
Followed a similar pattern, $4.1 billion in 2024, just slightly down from $4.138 billion in 2023, a decrease of about 1.1%.
And that translates to diluted earnings per share, or EPS, of $8.86 in 2024 compared to $8.94 in 2023. So earnings per share also tracked that slight overall dip.
Right. Now, looking at the rates, a positive sign was their gross margin rate. That improved to 28.2% in 2024 from 27.5% in 2023.
Oh, so that means they're making a better profit margin on the actual goods they sold? That's good news.
It is. But their selling, general, and administrative expense rate, think costs like payroll, marketing, rent, store operations.
The cost of doing business.
Exactly. That increased to 20.6% from 20.0% the year before.
Why the increase there?
Well, the report notes these rate comparisons were impacted by some accounting reclassifications compared to prior years, but importantly, it didn't change the actual operating income or net earnings figures. But the main drivers for the increase in that SG&A rate were things like higher team member pay and benefits, and also increased general liability expenses.
Okay.
These were partly offset by lower spending on store remodels compared to the year before. So a few moving parts there.
Got it. Okay, moving on to the balance sheet snapshot. How's their cash position?
Cash and equivalents were up significantly, $4.8 billion at the end of fiscal 2024 compared to $3.8 billion the prior year.
Having more cash on hand, that definitely provides flexibility. What about inventory?
Inventory levels also increased. They went from $11.9 billion in 2023 up to $12.7 billion in 2024.
Any reason given for that buildup?
Yeah, the report gives a couple of specific reasons. One was earlier inventory receipts, basically getting products in stock sooner.
Okay,
And also deliberate investments in certain categories to support future growth and, importantly, ensure they actually have products available for customers, boosting those in-stock levels.
makes sense. Trying to avoid empty shelves.
Mhm.
And shareholders' investment.
That also grew from $13.4 billion up to $14.7 billion. That's essentially the company's net worth from the owner's perspective.
Okay. How about their cash flow from operations? Where did the actual cash come from and go during the year?
Right, so operating cash flows were $7.4 billion in 2024. That was down from $8.6 billion in 2023.
Down. Why was that?
According to the report, the primary reasons for that decrease were higher income tax payments during the year and also changes related to their inventory levels and how they managed accounts payable.
Okay. And their capital expenditures.
Yeah.
Money spent on long-term stuff like new stores, remodels, tech.
Yeah, CapEx was substantial, $5.4 billion in 2024.
Wow, $5.4 billion. That really reflects their strategic commitment, doesn't it? Investing in those pillars we talked about, enhancing the experience, building out the network, supporting digital.
Exactly. That number aligns directly with their stated strategy.
And finally, on the financials, return on invested capital, ROIC. How effectively are they using their capital?
So the report states their ROIC was 15.4% for the 12 months ended February 1st, 2025.
15.4%. How does that compare?
It's a slight decrease from 16.1% in the prior year.
Okay.
But while it's slightly lower, 15.4% is still generally considered a healthy return. It indicates they remain relatively efficient in deploying capital within the business, even with those increased investments we just saw.
Right. So navigating a variable year, mixed financial results. How does Target talk about creating value specifically for shareholders? The report seems very clear on their priorities here.
They are. They have a very specific ranked approach. Priority number one, invest in the business itself for profitable growth and, maintaining their existing operations.
Which makes sense. That $5.4 billion in CapEx we just talked about fits right in there.
Directly aligns, yes. You have to ensure the core business is healthy and growing before you do anything else.
Logical. What's priority two?
Priority number two is maintaining and growing a competitive quarterly dividend.
And they definitely walked the talk on that one. They declared $4.46 in dividends per share in 2024. That's up from $4.38 in 2023.
Yep. Actively growing that dividend payout, which shareholders tend to like.
For sure.
And then their third priority is returning any excess cash to shareholders via share repurchases. But importantly, they frame this within the goal of maintaining their credit rating. They're not going to jeopardize that.
Okay, balancing act there. They have that big $15 billion share repurchase program authorized back in 2021.
Right.
Did they use much of it in 2024?
They did. In 2024 specifically, they purchased about 7.2 million shares, investing just over $1 billion, $1.015 billion in those buybacks.
$1 billion back to shareholders through buybacks.
And as of early February 2025, they still had over $8.6 billion remaining under that authorization.
Wow.
So that indicates significant potential for future share buybacks, assuming cash flow and market conditions allow, and it aligns with those other priorities.
So it seems like despite that slight dip in top-line sales and operating income in 2024, they clearly remain committed to their capital allocation strategy.
Absolutely. Investing heavily in the business, increasing the dividend, and executing share buybacks.
Yeah, that shows a certain confidence in their long-term trajectory, wouldn't you say?
I think so. It demonstrates their balanced approach to returning value while still continuing to fund those strategic initiatives they believe will drive future growth.
Okay, so wrapping this up then, what key challenges or risks does the report explicitly call out for the future? What are they worried about?
Well, competition is, unsurprisingly, a big one, particularly as retail shifts further digital and consumers remain really focused on price and convenience.
Right. They have to keep differentiating themselves to maintain that Target draw, make sure people keep choosing them.
Exactly. Making sure that unique experience and product mix is enough. Another key risk is predicting and responding quickly to, ever-changing consumer preferences. Getting inventory and product mix right is just harder than ever.
Yeah, something pretty much every retailer has struggled with post-pandemic. Any others?
Inventory shrink is also mentioned specifically as being at elevated levels compared to historical norms.
Shrink. That's basically loss from theft, damage, error.
Correct. And it's a direct hit to profitability that they, like many others, are actively trying to manage.
Yeah, that's been a huge topic impacting lots of retailers lately.
Technology risks are also highlighted their reliance on complex systems, cybersecurity threats. The report even mentions past scrutiny over data breaches.
Right, emphasizing how important protecting customer data is.
Absolutely. And then, of course, external factors,
Mm.
potential supply chain disruptions, macroeconomic conditions, consumer confidence swings, geopolitical events. Those are always risks for a global operation like Target.
Standard stuff for big companies. Anything else jump out?
And quite notably, they explicitly call out reputational risks. The report directly references past reactions to social issues,
Okay.
using their 2023 Pride Month product assortment as a specific example of facing conflicting expectations from different stakeholders.
Wow, that's very specific to list in an official 10K report.
Yeah.
It really highlights the complexity of operating in today's environment.
Yeah. It really does. It shows that managing public perception and navigating these potentially polarized consumer reactions is a significant focus and, frankly, a challenge for the company.
So how does the CEO frame their forward look, acknowledging all these challenges?
Well, the letter focuses on navigating these near-term challenges while still working towards their long-term ambitions. The plan is to continue building on their core legacy.
That Tarzay thing.
Yeah, emphasizing product and experience differentiation, continuing to invest in their strategy, their capabilities, their team, technology, operations, all the things we've discussed.
Okay. And there's a message of confidence in there too.
There is confidence in their ability to create value by focusing on what they can control and, crucially, by listening closely to consumers.
So sort of sticking to the plan, basically.
It seems like a commitment to their established strategic path, grounded in their unique model, but with a clear recognition of the dynamic and sometimes difficult environment they operate in.
Okay, so let's try and pull this all together then. Our deep dive into Target's 2024 annual report shows a company that, well, navigated a challenging, pretty variable year. There was that slight overall sales dip, but as we noted, that's partly explained by the prior year's extra week. But critically, they saw continued strength in traffic.
People coming through the doors or clicking online.
Right, and robust growth in their digital channels, especially those leveraging stores for fulfillment. Even as physical store sales were down slightly and the average amount people spent per trip decreased a bit.
And they continue to invest heavily in that core strategy, focusing on their differentiated product mix, the owned brands, the partnerships, the value proposition, and enhancing that overall guest experience through new and remodeled stores and technology.
And financially, yeah, there was a slight dip in operating income and net earnings, but they improved their gross margin rate, and they remain really committed to their shareholder value creation priorities.
Absolutely. Investing in the business first, growing that dividend, and executing those share buybacks.
All of this while explicitly recognizing and presumably planning for key risks, competition, shifting consumer behavior, operational stuff like inventory shrink.
And navigating that complex landscape of reputational risk in what can be a socially charged environment.
So this dives straight into their 10K, their own words. It really gives you, the listener, a much clearer picture of the specific factors driving their performance and strategic decisions. It helps cut through maybe some of the external noise and understand their own account of the business.
Yeah, it reveals a company actively managing a complex balance, trying to stay true to that Tarzay brand identity, pursuing growth in key areas like digital and store experience, while also acknowledging and addressing some pretty significant internal and external challenges.
Which leaves us with this provocative thought for you to consider. Given how explicitly Target called out reputational risks tied to social issues and conflicting consumer expectations in their official report, and how central reputation clearly is to their brand, how successfully do you think Target can continue to evolve its identity and values while navigating what seems like an increasingly polarized consumer landscape moving forward?
It's a fascinating challenge, not just for Target, but really for any major retailer today. Something to think about.